Well, the after-hours session is littered with basket cases, particularly in tech. You've got weakness in MongoDB. It is cutting its forecast. Dell with impressive results, failing to impress investors, however. And then you have Marvell Technologies, which is also down. Generally, you have seen this narrative of a sudden and abrupt slumping demand for these software companies. You coupled that with weaker economic performance in the first quarter. Let's bring in Andrew Slimmon, Senior Portfolio Manager at Morgan Stanley Investment Management. Andrew, how much stock should we put on this? It seems very abrupt slowdown that these software companies are telling us that they're experiencing.
Is it a slowdown or is it a shift in spending? That's the question, right? You heard some of the AI companies say business is very strong. So I think it's kind of like the consumer. You know, we had some consumer companies that reported very weak numbers and very strong numbers, and clearly there's a shift in the consumer spending. I think there's a shift going on in CapEx spending, and software seems to be on the losing side, at least short term.
I think that's great perspective. And does that make you feel comfortable that, you know, the companies that are more geared towards that theme of AI spending can continue to win out the day?
Well, you know, all you have to do is listen to these big companies, mega cap tech stocks, talk about where they're spending their money, and it's clearly in the AI space. So, yeah, I would not fade that that concept, that trade just yet. Although, you know, these stocks have done very well, the semis, and they're probably ripe for a pullback as software jitters are going to affect the whole tech sector.
The spending, I think, has been well tolerated by investors right now on the expectation that there is a return. And so how much time will these companies get to show a return before the spending becomes a problem?
Yeah, I mean, that's a very good question. I wouldn't bank on it, but I would bank on the spending to advance. So I think the semis are the immediate beneficiaries. And I don't think I would go too much further than that because of your point, which is it never turns out quite as expected. And I think, you know, I've been in the business a long time. I remember when the internet first rolled out and speculation, the winners and losers turned out to be, you know, very, very wrong. I wouldn't bet on down the road winners and losers.
And of course, because of how influential tech is on the indices, actually it was a pretty strong day for most other things outside of tech. But the S&P fell because tech was weaker. What are you thinking about that rotation that we're seeing into some defensive like sectors, like real estate, like utilities?
Yeah, that's a good point. So look, I think if I had to kind of build the bearish case, and I think the market's going to be higher by year end, but gosh, we've had really good move. And as we move into the summer, I'm always a little bit more squeamish, a little nervous. And if I had to build the case for what could cause a pullback, I think it's a combination of inflation ending up a little bit more persistent than people believe, combined with what happens if it comes at a time when we get, you know, kind of weaker economic number. That will bring back the stagflation argument. But having said that, I think it's early. And the reason I say that is, well, yeah, utilities are doing well, but healthcare is not doing well. Mm-hmm. Consumer staples aren't outperforming. So the defensive group overall is not outperforming. Credit spreads are tight. Cyclical stocks continue to do well. So I think it's early, but I think there will be some type of more defensive rotation warranted, at least in anticipation of a pullback. And that's very tricky to do. But I think that's probably where we get a pullback this summer. I just think it's only end of May. It's a little bit early.
We're getting to some pretty critical Fed meetings, you know, where we thought, okay, if it's going to happen, it's likely to happen at these summer meetings. Although now with all this Fed speak, I'm not really sure. How are you thinking about that?
Sure, it's a great point. So I think right now, the inflation trajectory is down enough that the Fed can hold to the, there will be cuts down the road. And I really listen mostly to Chair Powell. My concern, however, is that if you look at the year-over-year comparisons, and that's the way the CPI is measured, the comparisons get much tougher as we move into June, July, August, because last year, that's when inflation numbers really came down. So my concern is, for now, we're comforted. The Fed will be able to lower rates, and that seems to help the stock market. But if we get 2-3 months in a row of not continued improvement, that's where I think the anxiety will build that maybe the Fed, will be higher for longer. I don't think they're going to raise rates, but there seems to be a lot of people hoping they'll cut rates, and I question that.
So where do you want to hang out for the next couple of months?
Well, I think, again, a very good move up. You've had some very big gains. I'm a long equity manager. We're taking some chips off the table in some of these tech stocks that have done very, very well. We're buying a little bit more defensive. But I wouldn't be surprised a month from now, the market is higher. I just think at some point we're going to get a pullback. And, everyone wants, when you've got cash on the sideline, everyone wants what I like to call, Amber, the no reason 10% pullback. But when you have pullbacks, it's always for a reason, and it never feels so good. So, I a little bit more defensiveness going into the summer months, makes sense to me. Whether that's a little bit more healthcare, I think the story of these GLP-1 obesity drugs we're just learning more and more details about it. Or I think the utilities that they pull back here, I think that's a very compelling play as well.